Good morning, everyone. It is a nice 31 degrees here we're in Killeen, Texas. Headed back to the house after dropping off my wife at work. Pick up the kids, take them to school. But I was just thinking, and this is very interesting because in our line of work, financial planning, finance, what I went to school for, it's a very different outlook and take on asset management and true risk reward notion of the stock market and investing. It's a far more real kind of valuation versus like just price. And it kind of got me thinking, the way I trade stocks and things, it's much of a feel of a price action volume, indicators. It's a very detached world from the actual investing part and that risk reward ratio that is created when you purchase stock, and I guess it's traditional kind of valuation. And it seems to me that type of valuation takes a long time to play out, decades potentially. And in the short run, it can go up and down, and it can go all over the place. And that is something that many people tend to forget. When you watch CNBC or read Yahoo Finance, all these finance media people, and they talk about how much a stock should be worth, price targets, and all of that nonsense. That's all in well, because that's what they think, and they're the professionals, right? They're the ones evaluating this stuff day in and day out, and it gets really kind of confusing. And the reason I bring this up is because people think that they can beat the market, and I'll be the first to tell you, I try every year. But I don't use the standard approach to try and beat the market. I try to beat the probabilities that the market gives me versus the actual stock. So I trade other things, derivatives. But anyway, to kind of put it into context and to talk a little bit about why inflation hurts, or maybe not inflation hurts, why inflation kind of is a big thing to consumers, but the stock market doesn't really care, because inflation is what really makes the stock market go up, right? It is the discounted future cash flows brought into today's price. So in actuality, while yes, inflation does hurt because your discount cash flow method has to take into consideration inflation, but all your numbers are also going to be inflated, and ultimately that's what can raise your stock price notionally. So if you have a 7% inflation rate, and you're charging 7% more, your margin didn't change much at all. Yes, your discounted cash flow method does have a larger inflationary variable, inflation metric in there to run your calculation. But if you're doing things the way you're supposed to be doing things as a business, your bottom line is going up by that same amount anyway. And if you have scale, you're scaling with more of that same inflationary number. So in actuality, it should look similar. And the reason why your stock price goes up 20% is because of, you're doing good business and inflation, right? Now, to combat inflation, detrimental to their balance sheets. They might not be able to service that kind of debt with that high rates, especially with no income. So that's why the growth stocks typically don't like inflation, because it hurts their borrowing capability. That doesn't mean that they cannot grow during an inflationary stages. The assumption, market assumption, is that if they're riskier assets, then we should stay away because they're riskier assets. And I think what people have forgotten is that the price of the underlying security, the price of the stock, is, for all intents and purposes, supposed to be the discounted cash flow method of its future cash flows. And there are so many companies that have a negative cash flow, which then theoretically should make their stock worth negative money. But yet here we are with, negative earnings every quarter, but yet the stock still trades for, a market cap of several $1 billion. So what then? What's going on? I mean, it should be a home run, right? Short the stock. The stock ain't making any money, but yet it's still trading at, $2 billion market cap. Things worth negative money, right? Unfortunately, it doesn't work that way. And of course, it doesn't, because if I could tell you that over a YouTube video and it actually worked, it would stop working. Let's think about that a little bit. Let that sink in. So, what am I talking about in this risk reward thing? To sum it all up, and to make this video even longer, when you have money, you have choice. When you have time, you have choices. You can do what you want with your time, right? That's just how it goes. Money also has that time component to it. Money can sit in the bank and earn barely any interest and get eaten away by inflation. Money can go to work in the marketplace, potentially make more money than it would in the bank, with risk. If there was no risk, then the stock market would return exactly what the banks return, because that is the theoretical risk-free rate. In economy and in finance, we learned that there's no free lunch. And basically what that means is there's no way to get more without some kind of a gimme or a gotcha, right? For every pro, there is a con because of the time value of money. That means that if I put money in the bank, it's safe. The pro is safe. The con is no growth, right? Over time. This is a time-related phenomenon. Put the money in the stock market, well, the stock could go to zero. That's risk. But the stock could double. That's the reward. And only when we become comfortable ourselves, become comfortable with those risk-reward scenarios, only then can you really understand and kind of make those informed and educated decisions on your money. Because if we told you, as a financial advisor, if the financial advising community as a whole were to tell you that if you put your money in an index fund, it will return 8% per year, very low fees, if any at all, and that's probably the best way to return to invest your money. Of course, with the slight caveat that you can lose it all, stock market could go to zero, past performance does not indicate a future performance in and by any means. So, what then should you do? The stock market is not the only thing you can do. But financial media doesn't make any money if you don't put money in the stock market, because they get paid by the exchanges, they get paid by all the mutual fund companies, they get paid by all the, well, not mutual fund, all these mutual fund companies like Fidelity, Schwab, they also, obviously do ETFs and everything, and that's fine. It's just the name of the game. But what I kind of wanted to just discuss is that, and we're already 10 minutes in this, 11 minutes in this video, is that your money has options. You can choose what to do with your money. You don't have to do what I tell you. You don't have to. In fact, I don't tell anybody to do anything. I'll tell you what I do. That works for me. You can do whatever you want. I can do whatever I want. My money. But there are some times when you need to have a different opinion. And you've lived enough life to know that there is no reset button. You can't put your money in the stock market, and if the stock market tanks, be like, well, I should have done this instead. We don't get that opportunity. We can wait till it comes back, but some people don't have the luxury of time again. Time is where the proverbial, problems lie. Because we know what a snapshot of our account value looks like today. We have no guarantee in the stock market what it will look like tomorrow. I've run probabilities. I can tell you about how, the probability of the next day being an up day after a down day, it's pretty much random, but there is a slight bullish, meaning a green day probability, but it's small. So even with all the mathematical engines and minds behind stock market and theory and technical analysis, the chance of it being an up day is still 50-50. Yesterday we finished down. Today we could finish down. The market could streak this way for 8-10 days before we even see a little glimpse of green. Intraday, of course, it'd be all over the place. Who knows? Now, as a trader, I like that stuff. The more volatile the market is, the better it is for me, because that means I have more action to evaluate, right? But all this stuff in the beginning of the video, I'm not even talking about. My risk reward is based off of charts, probabilities, and volatility pricing. It's not based off of whether or not this company is feasible, whether I think it's gonna be around in the next couple of years. I don't really care. In fact, we were trading Hertz when Hertz, the rental, when Hertz was already in bankruptcy. It was still listed on the exchange, so we could still trade it, even though the company itself was negative money. They were going through bankruptcy. So the stock market's a very interesting place. It is. And you have to kind of accept that short-term price action, stuff that traders do, is not what you want to take any part of. Yes, it can help you determine an entry point for your long-term position. But in all honesty, it's not a good thing for an investor to look at, or even to consider thinking about. If you want to reevaluate your portfolio every 3 months, I think even that is too often. Maybe take a look at it every month or so. Statement, market didn't do so well. Oh well, I don't need this money for another 10 years. Make some subtle changes. Maybe you heard about a nice stock you want to allocate, 0.01% of your portfolio to. But I would not and do not recommend that if any of you guys want to make trades, use an investor mentality. What does that mean? It means if you think Coca-Cola is going to the moon tomorrow, it's going to just move. Forget everything anyone says. Coca-Cola is going to the moon because, Coke is the greatest beverage ever created by man. I wouldn't buy that and hold that for, 2 weeks thinking it's gonna moon tomorrow, moon by the next full moon. I would probably tell you to buy it on a down day at a price you think it's worth based on fundamental analysis, discounted cash flow method, entry point somewhere below the VWAP on a down day, and then hold on to it forever. Don't sell. Because once you do, you live with the regret of selling something that you thought was going to go to the moon. And chances are, if you're as lucky as I am, that the moment you sell that, it will go to the moon. It's interesting. I'll probably talk about this in a later video. If anyone's still watching this video, good gosh. I mean, this has turned pretty much into a rant for me. But if you're still watching this video, I bought this book. It just came out, Amazon bestseller in finance. It's called The Unlucky Investor's Guide to Options. And it's written by the trading group that I follow, or one of the trading groups that I follow, who base their trades on options and statistics. And I love it because if you're a lucky investor, like anything you touch goes to the moon, then you are a terrible investor. And the reason why is because you don't have any experience in bad investments. And a bad investment in the stock market is random. Because if you're a trader and you're holding it for a couple days, couple hours, it can be really, really like uncharacteristically different. Like you can have something that goes to the moon because it was short squeeze, which has nothing to do with fundamental analysis. And then all of a sudden it's gone, right? Short squeeze is done. Stock went from $10 to $30. Now it's back to like $5, right? And you're like, what happened? I thought this thing was going to be worth 400. What's going on? And unless you experience those things often, you kind of realize that you have almost no edge. Unless you're in the market for a long time, holding for 20, 30 years, there's zero edge. Unless you have insider information. If you do, don't use it because then you could go to jail. That's terrible. So, make sure you do what makes sense for you based on your risk and reward tolerance, your expectations. And make sure you don't just believe that there's only the stock market. There's other things. There's tons of other things nowadays with financial innovation. So if you're still here, again, thank you for watching. I just got home in the garage. But in little over an hour, we'll have to drive the kiddos to college. I'll see you in the next video.